So the another a question I get a lot is what happens if you sell a covered call and the price drops a ton. So let's just say you sold the covered call and your cost basis is 120, and you can see that Nvidia is trading at 104, right? It's trading at 104, so that's a $16 difference. You're underwater by 16 points or $1,600, right? So what do you do? What do you do then? Okay, all right. So let's talk about the covered call, you guys. This is a great strategy to currently be that currently start or to be in right now. It's obviously better to start it than to be in with some of the stocks that have fallen so much. But let me explain a number of ways you can execute a covered call. And let's go out. Let's use NVIDIA for example purposes. And and so if you're going to start a covered call as like right now, the old terminology is called a buy right. You buy the shares, you buy 100 shares, and then you immediately sell the call, and you do it all as one trade. It's called a buy right, right? And you are writing a contract when you are dealing with options, so it's a buy right. Okay? And so when you are the option seller, technically you are creating a contract. You're writing up a contract that does not exist. That option that you sell does not exist until you sell it. And so that's why they call it a buy right. And so in this case, we're buying the call, I mean the 100 shares, and then we're selling the call. And so most traditional covered calls, you're selling something out of the money, the call. And a lot of people try to sell at around a 30 delta, right? So that you kind of have some upside, and then you have a little protection to the downside. The premium that you receive, let's just say it's 370, 375. That 375 that you receive, that's a cushion. So Nvidia can drop $3.75, and you will still be at that point break even. Once it drops below the 375, then that's when you'll start losing if you did a buy right at this point. Because as you can see, your cost basis here is basically at the 100 strike. Okay, because 100 times 100 is 10,000, so you're basically at the 100 strike here. And so once it goes below that, that's when you start losing. So covered calls, they give you a little protection to the downside from the call that you sold. Whatever that amount you receive from the call, this is the call that you're selling in this example, that gives you a little cushion, right? So because you guys, as primary option sellers, we are the insurance company. We're the one woman or one man and Geico that we're running. And what happens when you're running an insurance company, the premium that you collect, that is your cushion. That's your profit and your cushion from loss. So if you collect $1,000 for example purposes, right? And then the person that you insured goes out and gets into a wreck, and that wreck equals $700 to fix, not including deductible and all that. They just say they don't have a deductible. The wreck is $700. So my question is, does the insurance company lose at this point? Does the insurance company lose at this point? Anyone can answer. If you were running your insurance company and someone paid you $1,000 and then went out and got into a car wreck that costs $700 to fix, then what? Go ahead.
I was just gonna say you still be up $300.
Exactly, exactly. You'll still be up $300. So you don't win. You then if you're running your insurance company or the insurance company you're with, you don't win what you wanted to win, right? You wanted to win that entire $1,000, but you don't lose because the wreck didn't supersede the premium that you paid. So insurance companies, how they protect themselves is trying to determine the right premium to sell you, right? To charge you the right premium to charge you, and then your deductible, right? So that the premium you paid them plus your deductible is the insurance company's buffer. So you can get in a fender bender or a decent sized accident depending on and depending on how much premium you paid them. So in this example, if this was a 6-month policy, right? If this is a 6-month policy and you got into this accident with in the, you know, the first 3 months, well, okay, they won $300 on you. And if you don't get into an accident again after before the, once before the policy is over, then the 6 months is gone. And then what's going to happen next? What's going to happen next when you renew? What's going to happen next when you renew your policy? Anyone can chime in.
Would the premium be higher?
Right. Exactly, right? Because what's going to happen is now you're considered more of a risk. The volatility, if we're going to use options wise, the volatility has increased. And so the insurance company, they didn't lose on you, and they definitely going to figure out how not to lose on you the next time because you become more risk. So they're going to charge you more for that same policy, that same 6-month type of policy. They're going to charge you more when you renew because you just got in an accident. So a lot of people, if they get in a little fender bender, they decide to fix the fender bender themselves outside of their insurance company so that their insurance company won't increase their rates significantly after an accident. So it's important to understand that we're running our business like that as option sellers, and that's including the covered call, and that premium that we receive for that covered call is our cushion. And if for some reason the trade starts to go wrong for us, and if we don't lose technically, or if we lose and we're going to do a new, we're going to sell a new call, then we're going to probably try to get more for that call if the volatility has increased. But the key is understanding your risks when you first start the trade, right? Understanding, because that's when you can control everything. At least initially you can control everything. And so if I was going to do a buy right and I was worried about Nvidia falling a lot, then I wouldn't sell this 30 delta basically call, because that's giving me three, that's only giving me 300 or $3.75 cushion, right? That's $375 here. That's my cushion. Yes, if it jumps up, if my cost basis, I just say if my cost basis was 104, if it jumps up, I'm gonna gain $15, right? I'm going to gain $15 if it jumps up, plus the premium that they paid me, plus the 375, because the 104 plus 15 is 119. So that's how much I'm going to be able to make. I stop losing at the 119. Excuse me, I stop winning. I shouldn't say stop losing. I apologize for that. I stop winning at the 119. So I like to use the analogy for people to understand these covered calls is that the shares that you own for the covered call, the 100 shares, that is your house. That's the house that you own. Then the price that you sell it at, right? The price that you sell it at, that's you selling your house at a certain price, right? So if we sold this at the 119, that's you selling your house at that certain price. And so you have to subtract what you paid and all of that kind of stuff, and then so the most you can make is in this example is the $15 plus the credit you received. But your house is gone. Your shares are gone once you sell it at the 119 price here. Right? Yeah, you can go buy another house. In this example, you can actually go back into the same stock if you wanted to, right? But it's you get the appreciation. So don't think of covered calls as a negative thing if it jumps up. Especially if you're doing a buy right and it jumps up right away, don't consider it a negative thing. You've made money. Yeah, maybe you're not going to make as much as you want. You thought that this would be safe at the 119. You'll just collect a little bit more because you're trying to be in a video for the next 5 years, whatever the case may be. You can just jump back in. You've made money. You can jump back in, but don't be disappointed. It's like buying a house and you buy it for 100,000, you sell it for 150,000, you make 50% on your money, and then you move on and then you realize a year later the house is now going for 200,000. Well, you maybe you could have sold it for 100% profit, but you got a 50% profit, and you never know what's going to happen in the future. Housing prices can drop. I know it's rare, but they can drop. I'm actually surprised housing prices hasn't dropped across the country since we had this huge kind of spike up 20 plus percent, or 20 darn near 20 plus, or down to 20% for 2 straight years back in what, 2021, 21, 22, something like that. So I would but if you remember in 2008, a lot of houses Definitely in California, New York, places like that, the housing prices dropped and dropped quite a bit. Yeah, they're higher now. Years later, they're way higher, but they can drop. Anyway, this is this is how you want to think about your covered call, especially when you're doing a buy right, when you're buying the shares initially and then you're selling the call. But if you wanted more protection to the downside, right? Because let's just say that the strike price here, you start losing at the 100 strike here, right? If you want more protection, you can move this up when you first do your buy right. So let's just say you decided you're going to move it up to the 106. Well, you can't make as much, but you won't lose as much as well. So now instead of the $10 strike, you're at the $96 strike here, right? So in the video would have to fall to the 96 price before you start losing. And if it jumps up, you're still going to have the potential to make $1,000. You're not going to make as much as you were going to be make on the other one. That was up to $1,800, a little over 18. But now you're still going to be able to make $1,000, but you're going to protect yourself more to the downside. Okay, that 96. So when was Nvidia at 96? So the low for Nvidia, recent low, is was man, I that's interesting. I didn't realize it got all the way down to maybe 90 or something like that. Maybe that's even. Let me see that the low is saying the low there is saying $90. So 90.69, that's what it got down to on 8.5. So yeah, that's still lower than what this is here, but you get the point. You protecting yourself a really decent amount down from where it's currently trading at. Now, that's still selling the call out of the money. But what if you decided you wanted to sell the call in the money? So let's just say you decided you were going to sell something deep in the money at the 36 price. Well, if you sold it at the 36 price, you're not going to get any upside besides the premium that someone's paying you for that. It's going to be some extrinsic still. In this case, you're going to make 500, let's say $70, and your call space is going to be that 90 strike now. So now it has to fall back to where the low has been, the recent low has been at that 190. But you have darn near a 70% chance of winning the 570 when you do a deep in the money covered call here. It's a deep in the money covered call. You don't care about the upside. You're just trying to get that premium, that money's here. Plus, you're trying to protect yourself from the downside. So you don't start losing here until it drops below 90 a share. So it's a number of ways you can set up a covered call. You can do it the traditional way and you're selling the call deep out of the money, right? Like a 30 plus delta level, 30 or higher delta level. Or you can sell it out of the money but closer to at the money. Or you can sell it in the money. You can even go deep in the money like I'm showing you here when you're doing a covered call. And what determines where you sell it at is all about your assumption and your risk tolerance and all of those type of factors. There's no wrong or right way to do it. It all depends on what you're looking for at that time. If you're looking for a lot of protection and that it would have to fall a ton before you lose, then you'll do something like this deep in the money covered call. If you're gonna do a buy right off the bat. And if you're looking for some really decent upside, you know, potential that and still get a credit because you don't think it's going to the 119 within the next 35 days, and then you'll do something like this. If you think it's going to 119 but not to, as I say, not to 127, then you can do something like this: sell at a 20 delta, right? Someone's still going to pay you a little over $200, and that's going to be your cushion. It's not going to be a huge cushion, but if you're more concerned about it jumping up a lot and you want to get the most you possibly can to the upside, then you sell the call further away. You sell the call further away. But if you're nervous about the markets, you think things have been up a lot, then you err on the side of caution. So the a question I get a lot is what happens if you sell a covered call and the price drops a ton, right? So let's just say you sold the covered call and your cost basis is 120, and you can see that Nvidia is trading at 104, right? It's trading at 104, so that's a $16 difference. You're underwater by 16 points or $1,600, right? So what do you do then? What do you do then? So I tell people to say, okay, that's the situation I'm in. I hopefully I love NVIDIA, and I keep a record of my 1600 call spaces. Even if I have to have a little notebook to the side, whatever the case may be, I'm going to keep a record of my call spaces. So I know right now, for example, I have a $1,600 call spaces. So let's just say I was starting off and I was doing another 35 days, and I have the shares and I want to sell a call. Well, if I sell a call the and collect $600, I just say, well, my $1,600 call spaces immediately drops to $1,000 because I just collected $600. I just collected $600. So now my call spaces is 1,000. I need this to go up another 10 points for me to break back even. I need to make another $1,000 to break back even. So if this is the trade and I collected 600 and it's trading at 104 and it jumps up, well, I'm gonna and it takes my shares away again. Well, I'm gonna gain another $700, right? So now my call spaces is 300. My shares are gone because it got sold at 111 and my call spaces was higher than that. Okay, my call spaces was higher than that. So now what I would do is, now if my call space is 300, my shares are gone. I would go to another, let's say 35, and this is all of this is not apples to apples, but it's close. And now I can look to do another buy right, or I can look to sell a put and collect more than 300. So if I sold a put and I just say I decided, well, I'm going to sell this put for 400, I just say it's 400. Well, now my cost basis is a positive 100. And if this expires, if NVIDIA expires above 93, I have won $100 off the trade. And maybe it's taking me 3 months. Maybe it's taking me 6 months. Maybe it's taking me a year. Doesn't really matter. If you love NVIDIA, you just keep chipping away at your cost basis by selling things and lowering your cost basis. And if it jumps up, that's going to help you as well. Just keep a record of your cost basis. It doesn't take, you don't have to be a rocket scientist to do it. You can just have a notebook and you can say, okay, when I first got into the trade, my cost basis was, at the $100 was, I received $100. When I lost, I my or when the market dropped a lot, my cost basis became $1,600. Then you just use the example that I just did. You just start to sell things against it and slowly erase this $1,600 cost basis. This is going to happen to you if you doing our safeguard strategy, if you're doing a wheel strategy type of process, if you're doing cover calls. Eventually the stock is going to fall a ton on you and your cost base is going to be way out of whack. You just need to know it, and you write it down, consistently write it down, and you will chip away at it.